Welcome to the daily update, where I'll go over the action in the market for Thursday, April 17th, and we'll see how things look for Monday, April 21st. The markets are closed on Friday for Good Friday, so it's a holiday weekend and a holiday shortened week in the market. So we didn't really see much of a change for options expiration. Volume was below average, and by the time we ended up closing, we were little changed from what we saw on Wednesday. We're still looking more negative, and now we have a new addition to the death cross group. The Dow has now seen its 50-day moving average drop below the 200. So pretty much all the major indexes and even some industry groups that we follow are turning more negative, both in the broad term across all different market caps. So something can be said that, okay, when we see these death crosses and we're not necessarily in a recession, does that make it less powerful? Well, go back to 2021 into 2022. Or are we leading up to a recession? The market likes to look forward and they're anticipating a slowdown. We're not seeing growth outperforming value. The market is still getting more defensive. So we can keep that in the back of our mind that maybe we can come up out of this and, a good couple of days, nice solid up moves, seeing growth outperforming value, that could turn things around. But we've been waiting for that, and it just doesn't seem to be happening with any consistency right now. Okay, so right at the open, we did have a higher open. We were above the daily pivot at 52.88. Then we declined. After that, we went below the unchanged level, and then we were able to climb back up to the daily pivot and get above 5,300. Then we went down again. Prices declined back below 5,300 and below the daily pivot, and we still were able to hold on to a slight gain. We were up 0.13%, virtually unchanged, but we were up, so it goes in the books as an up day. But we were below average with volume, even though it was options expiration. We are negative in the short, intermediate, and long term now. We did see interest rates go back up, and inflation seems to be under control right now, but the market's looking forward and they're worried about inflation really picking up. And this has to do with the tariffs and the trade wars and things going on with China and different countries. And as we've seen now for pretty much all of 2025, is that there's a real uncertainty about what's happening now, and that's putting the market more on a defensive type of posture. Okay, so some comments. The Dow did get taken lower in Thursday's session, and that had to do with United Healthcare's earnings. They were not well received. And there's only 30 stocks in the Dow, so if one of their components in United Healthcare is the biggest component of the Dow. So if they go down, that's going to take the Dow with it. We are coming down with the VIX, but we're still well above that 20 level, but we're dropping under 30. So we're seeing a little bit of an improvement coming in at 29.65. And now we have, as I said, a new addition. We not only have the S&P and all the other indexes that I'll list here, but now the Dow is on this list. The NASDAQ 100, small caps, mid caps, micro caps, the Wilshire 5000, and the bank ETF. That's one of the sector groups I just want to keep an eye on, the banks, because we had some problems a couple years ago. And if we're coming into some kind of a financial situation similar to what we saw during the great financial crisis, we just want to keep an eye on the financial sector and some of the charts within the financial sector. On a short-term basis, we're still looking extreme. Mainly these are momentum oscillators with the slope oscillator and the MACD. They're both trying to improve, but they're still giving really extreme negative readings, and we're still far away below the 20-period moving average. That's what the boom indicator measures. And we're still extreme positive with the Stochastic RSI. It's seeing something positive as far as momentum. Then in the intermediate term, we have the rate of change going back 50 periods. That's still extreme negative. The TTM squeeze is showing some weakness again. The PMO, the price momentum oscillator, trying to improve, but still giving an extreme negative reading, as is the Copic curve. And we're also far away to the underside of the 50-period moving average as measured by the boom indicator here. The 200-day simple moving average dropped off the list, but we're still looking extreme with the 150-period simple moving average. No real change. There's this battle going on now that President Trump wants Jerome Powell to step down or at least get rid of him when his term is up. And not real, a lot of love going on back and forth between the president and the Fed right now. Now, the Fed is supposed to be an independent agency, so and they're supposed to be apolitical, but that's not how some people are interpreting things. They are interpreting it as being more political, and uh, President Trump thinks that interest rates should be lowered to help stimulate the economy. But again, remember, he's coming from a businessman's angle. Of course, he's going to want something like that. He wants anything that helps to stimulate growth. But the Fed is saying, well, it's our job to not necessarily cater to what you want. We need to do what we think is best. All right. And then the dollar was up. Still seeing some weakness overall with the dollar, but it did bounce in Thursday's session. And then interest rates also went back up. We are at 4.33% with the 10-year yield, where after Wednesday we were at 4.28%. We're still below that 25 level when we look at sentiment. We're coming in at 21, so that's an improvement, but we're still extreme negative. We have to get back above 25 to just become negative, where we had been at 14. And as far as our trend, we're still negative. It's still a weakening trend. Doesn't mean the trend goes away. It just means that we've been slowing down. And we saw that in Thursday's session. We'll see if that continues, as the market may go sideways here for a little bit to try to consolidate a little bit. But with I had the bias here at mixed, even though it was an up day and we saw a bit of an improvement, we're still looking at a more negative backdrop right now. And I'm keeping the momentum at mixed to negative for the time being. Again, it's because the bigger picture tends to be more negative right now. All right, the economic reports that came out, we had housing starts came in less than expected at 1.324 million. They expected 1.418 million. Last time it was 1.494 million. So we are seeing a drop in that. That is suggesting, going forward anyway, some economic weakness when it applies to housing. And building permits came in at 1.482 million. That was greater than the 1.455 million that they had expected, and also down up just a little bit here from the 1.459 million. So a decrease in housing starts, but an increase in building permits. Philadelphia Fed Index, this was a lot weaker than what they expected. They thought it would come in at 10. It came in at minus 26.4. Last time it was at 12.5. Then weekly jobless claims, they actually came down a little bit. That's still showing, at least on a shorter term basis, that the employment situation is still holding up. It came in at 215,000. The number that's been coming in is generally in the 220s, and they thought it would come in at 225. Last time it was at 224. Continuing claims did tick up a little bit, but we're just kind of at the higher end of the range where we've been at 1.885. Last time it was 1.844. All right, so here's some charts to go with that. See, overall, the 4-week moving average is coming down, and that is just showing the employment situation is still looking okay for right now. We're waiting to see if this really falls apart, and that could really lead us into a recession. But for right now, it's holding up, and even with the continuing claims, they did go up, but we're just kind of going sideways right now. I'm not seeing real big changes with that. So we put the red line here in initial claims, which have been coming down. We've been going sideways with the continuing claims, and then we have 4.2% with the latest unemployment rate, just to put it all together here. Then housing starts and building permits. This is a 3-month average where we're leveling out here with the building permits and actually declining with the starts, which is kind of what we're seeing in those numbers that I went through. And then housing starts did decrease over the previous reading. And then the Philadelphia Fed Manufacturing Index, it had been negative, but it was declining, and we're seeing more of a decline currently. Then looking at the change in liquidity, I'm not sure how useful this is. This is a very long-term chart, and it's great at showing you what's happening, but I'm not sure how much we can really use this in real time because there's a bit of a lag here. But basically, the idea is when the red line is above the black line, which is the S&P, that means there's more liquidity, and a lot of that money goes into the stock market and helps it really go up. Well, we've been seeing a disconnect between the two, but the market was still going up anyway. So you can try to say, well, it might have an impact, but yet not really making it all that apparent, at least over the last couple of years. And this is another chart that, in retrospect, could be quite useful, but we have a difficult time using this in real time because if you were to buy every time we spiked in the VIX, you probably do quite well. The only problem is when we spike, we don't know if that's the end of the spike or is the spike going to continue. There's really no set scale here. So, yeah, you can go back and put all these little red circles on here, but when we're really going through it, you don't know if it's over. You don't know if the VIX could, you might come in here and buy, and then the VIX could go even higher, and you haven't really waited until it topped out. There's still more room to go up. But anyway, that we do keep a close eye on the VIX in some different studies because it really shows more of the sentiment and the psychology of what's going on in the market. And we're seeing more money going back into tech, even with it going down, this whole buy the dip, seeing some weakness. Eventually, tech's going to turn around. At least that's what folks are thinking. And so we're still seeing a lot of inflows there. And then looking at systematic equity positioning. Now, this could actually end up being positive if we get down to a really negative reading here. But this is just using a systematic approach, and the performance has not been very good lately. And then this is confirming what I'm showing in other charts. This is the S&P 500 when the 50-period moving average crosses below the 200. Here it's blue and orange. That's called a death cross, and that's the long-term trend. And a lot of people talk about that. A lot of people notice it. A lot of people use this to make decisions. So they may be getting out of the market and actually going to cash, where in the program that I have, we actually look at taking advantage of downward moves. And we don't know if we could come back, but we don't see very many crosses here all that often. So but it can get quite volatile as the trend is working its way out. And what we see quite often, because moving averages are great when we're trending, but a lot of times when you see something happen with the moving averages, we'll see a counter trend that kind of goes against what the bigger trend is telling us. So that's again why we use a lot of different indicators to evaluate things. And then since Thursday was options expiration, this just shows everything that was expiring. 2.6 trillion. Yeah, it's kind of a little bit of chunk of change there, but we didn't really see a lot of pickup in volume. Now, there may be some carryover into next week as a lot of these positions, the options finish trading on Thursday. They technically expire on Saturday, but Friday is a holiday, and then there might be some squaring up that comes next week that could produce some volatility there. And then risk is still on according to this. Now, some other charts that I look at show that we're more risk off, but this is comparing stocks to bonds, and it's a ratio between the SPY, which is the ETF for the S&P, and the TLT, which is a bond ETF. And even though it's coming down, and we really dropped down here, it has been improving a little bit lately. But this Liberation Day, this is when the tariffs all kicked in, that is really confusing the markets currently. And then we did get retail sales earlier in the week. And one of the things to notice is that we've been going sideways a lot here with retail sales. And sometimes that happens. We go sideways and then a recession, sideways and then a recession. Of course, the whole COVID thing happened so quick, but we're not really breaking down here. And we don't necessarily see a real decline until we, in fact, do go into a recession, if that's what's happening. We're still waiting to see if that's how things are going to play out. So here's the chart. We did have a higher open right above the daily pivot, but not an awful lot of conviction. Dropped down and actually went negative there for a while, but then we're able to come back and go positive above the daily pivot. Drifted higher, but then drifted lower and ended up closing down below the daily pivot. So things are closed down then for the holiday weekend. So we're pretty much flat right now with the futures. They were up just a little bit. They'll keep trading through Friday's session, and then they'll close Friday and then resume again Sunday evening. But we were looking a little bit more positive. This is about the time when Europe opened, and Europe at least opened looking better, but then we just started drifting down as we came into the cash session. Not really seeing any kind of an advantage or disadvantage here when we look at the intraday growth versus value intraday chart. So a little bit of an improvement here, but not an awful lot of conviction. And I added this here to the chart where we were seeing earlier in April an improvement with growth outperforming value intraday. Now we're not improving. We were going sideways. Now we're actually dropping a little bit lower. That suggests the market's more defensive. The end of day charts, growth was up, but up less than value. It was up less with the mid caps and also up less with the small caps. So looking at the end of day charts, we were seeing an improvement here with the small cap growth to value, but now it's coming back down. And we're in between the 50 and 200 day moving average with the mid cap growth to value ratio. And we're seeing a recent death cross here with the S&P growth to value ratio. And we've been below the 200 day moving average for quite some time, going back to the early part of March. No real improvements here with the growth versus value ETF. We want this to be going up. That would be more positive. This going down is actually more negative while the market is getting more defensive. Not seeing an improvement here with discretionary to staples. We continue to decline. If we stay down here, eventually we'll see a death cross with this ratio as well. Looking at our trend, we're still below the moving average, kind of leveling out here as Thursday ended up being a quiet day, but we're negative because the red line is above the green line. Short term, we're also still below the moving average. We're negative with the red line above the green line here. And we really dropped off with volume, and you can see pretty much all this week. Now, some folks, this was a holiday week, not just for Friday, but for the entire week. And that might explain some of the drop off. Also, you had a market that just went crazy the week before, and then the week before that. And there's a lot of exhausted folks, and they're just kind of pulling back now and wanting to relax a little bit if possible. So we're still getting a high reading with the Ulcer Index here. This is a fear gauge. We are coming down under 30 with the VIX, but we're still above 20. So this is when we see negative annualized returns. We're also seeing a drop off here with the VIX of the VIX, but it's still giving quite a high reading. The momentum for the VIX has actually turned to down because we were really going up with the VIX and now we're coming back down. The MACD has picked that up as downward momentum and just ticked up a little bit here with this fear gauge and ticked down with this other fear gauge. So no real across the board confirmation there. And let's see, this is an old chart here. And then we had the latest reading. We still have the individual investors who are coming in at being extreme negative. And this is the 8th week now. So 2 months. These folks, usually we V bounce out of this. Everybody freaks out, we bottom, and then we start going up. Well, they're just camping out down here. And we did go up with the equity put call ratio daily chart. Not a surprise with this. It's a 3-day weekend. Things are going to be closed. And so some hedging may have gone on ahead of the weekend. And we're ticking down a little bit with the 5-day chart. This chart wasn't updated, but the last reading was that we're actually going up. So not a lot of confirmation there that things are going in the same way. But we look at the volatility risk premium, and it's really dropping down well below the band. Advanced decline line studies, we're still seeing what we've seen before. We're above the moving average based on price. We're below the moving average based on volume. A little bit of an improvement, but still below zero with our advanced decliners oscillator here. And just barely above the midpoint here with the short-term advanced decline ratio, a little bit below when we look at the intermediate term advanced decline ratio, and not really seeing much of a change here. Again, this might look like it's trying to improve. It's not that we're seeing new highs, it's that we're seeing less new lows after we were getting really extreme readings. We're coming down right about to the moving average, just a little bit above it with our smart money indicator number one, accumulation distribution, where we're now negative. We're coming down with the histogram with the Chaikin money flow, and the red line is starting to decline. That's negative. And we're declining right back down to the midpoint here with the Chaikin oscillator. So two of our three smart money indicators are negative. One you could still interpret as positive unless you're looking at the direction of the red line, which has been declining. We're negative with the vortex. We saw a little bit of an improvement, but we're still below the moving average here with this advanced decline line study. And we're seeing that pretty much across the board. All the indexes, even when they improve, they're still below these moving averages, which now are starting to decline. And a little bit of an improvement with those stocks above their 20-period moving average inside the S&P, but still getting a very low reading there. We're at 27%. A little bit of a tick up with the 50, barely a tick up with the 100, and a little bit more of a tick up with the 200-period moving average study. So here is the death cross. We're at the 50-period moving down below the 200. Just a pretty slow day for options expiration, and even to be below average with volume is kind of surprising there. A little bit of a tick up, but no real conviction with the 20, 50, and we're flat here with the 200-period moving average steady. Still extreme positive with the Stochastic RSI, and just a little bit above the midpoint with the Williams percent R, below the midpoint with the CCI 14 and the CCI 20. So not really showing an awful lot of conviction, either positive or negative, but we kind of lean more negative because the bigger long-term trend is now down. Nothing really extreme here with the short, intermediate, or long-term stochastics. And a little bit on the negative side here with the force index, showing a little bit of weakness here with the short-term moving average based on 20 periods. The lines are starting to go back down. And we're dropping back down below the midpoint. We're in the -1 standard deviations channel, so that's not extreme. And this is that new look at inflation. It's coming in at 1.36% according to Trueflation. Intermediate term, a little bit of a tick up. It's still negative with the balance of power. Still on the neutral side of negative with the go, no-go system. And also below the midpoint with our highest high, lowest low value chart. Starting to show some more weakness again and getting extreme with the TTM squeeze. It's turning to the lighter shade of red. Still extreme here with the rate of change going back 50 periods below that pink line. And slowing down, but still pretty high here over the last 10 periods with standard deviation, which measures speed, whether it's going up or down. Still negative with the ease of movement. We're negative with the Arun indicator, barely going back over positive with the S&P McClellan oscillator. So it's really hard to see, but we're trying to turn up here based on price, and we're pretty much flat based on volume. Positive here. We never did go negative after the big down day that we had on Wednesday, but we're going back up with the NYSE McClellan oscillator, so we're just barely starting to tick up based on price and volume with the summation index for the NYSE. And we had been negative. Now we're looking more positive with the Swanland trading oscillator based on price and volume. Trying to improve with momentum, but the PMO is just really having a difficult time getting above its moving average. We're just about at the moving average based on price and still a little bit below based on volume. So really no big changes here with the PMOs that are rising. Slight improvement with the buy signals, and a slight improvement with the PMOs above zero. We've gone from negative to neutral with the Elder's impulse system for the S&P. We're still positive with the dots underneath with the parabolic SAR. Still extreme here with the slope oscillator, but just going sideways right now. And we're actually looking a little more positive with the MACD, or at least we're above the moving average, but still, even with it bouncing back up, this is still an extreme negative reading. So a little bit of an improvement. We've actually turned positive with the TSI short-term oscillator. We're sideways with the slope, turning more positive, but still extreme negative with the MACD, right on top of the moving average with the PMO and a little bit above it with the PPO, where our longer-term oscillators are trying to improve, at least the tricks is, the KST continues to decline. And going sideways and still extreme negative with the Copic curve. Here's another look at that to give it a little bit longer context here. These very low readings came back in 2022 when we were in a cyclical bear market. And no longer extreme negative with the Sean trend meter. We're starting to cross back above 50 with the money flow. We're above 50 and advancing with the ultimate oscillator. So these are showing some improvement. We ticked up here, but we're still below now a declining moving average with unbalanced volume. We need to be more positive. It is more positive when we go above the moving average. Still below 50 with the RSI 14 and the RSI 9. And we're still declining here with the intermediate term trend. The blue line and the red line continue to go down. And we're below all the moving averages here with our moving average tree looking more like spaghetti right now. And still extreme when we measure how far away are we from underneath the 20 period moving average. That's still extreme negative. We're also far away from the 50. And we're still looking a little more positive here with the bullish percent index. It continues to go up. It's still below 50. That's when it will be officially positive, but we're above the moving average and continuing to advance. And we're seeing an improvement here with the NYSE bullish percent index and a little bit of a tick up with the NASDAQ 100 bullish percent index. This is a bigger picture look that we're trying to get. This is showing the market continues to get more defensive. This is what we saw in late 2021 before we went into 2022. We're now seeing that continue down here with this ratio of SPY to staples. Staples are more defensive. And when this is going down, that means staples are outperforming SPY. And this is still continuing to be negative. NAS index just we'll have to see about this if we end up getting some kind of a signal from that. And we are holding above this S1 support level with this weekly chart of the S&P, but we so far have not been able to reclaim this P, this pivot point here. So we're kind of in between both of these pivot points. And we're looking more negative here with the Heiken Ashi. We're red and pointing down with the Kegi. That's negative. Where we're positive with the Renko chart and we're still positive with the three-line break. So again, we're getting mixed signals here. Long term, we're still extreme negative. We're below this green line with the 150, where we're slightly above the green line with the 200 period simple moving average. And no changes here. Everything is negative in the short and intermediate term with the S&P, mid caps, small caps, and NASDAQ 100, where the mid caps and small caps are still negative in the long term. And then looking across the market, bonds are negative across the board on all time frames. Commodities are still negative in the short and intermediate term, and the dollar is negative across all time frames. And we had the sectors go up here, but energy, which often can be considered more defensive, staples, that's more defensive, real estate are more defensive, utilities, these are the areas that are more defensive, where communication, discretionary, and tech ended up being down, but these didn't perform all that well. Communication and discretionary were up, but not by very much. And then, so we saw some more negative signals right at the beginning of the day when the NASDAQ went below 16,87654. The euro is now starting to outperform the dollar as the dollar's in a downtrend. The energy sector had a BPI cross above 20 after getting extreme negative. This is where we see the death cross here for the Dow. The 50 period is crossed below the 200 period. And real estate, seeing a bullish MACD crossover, as are utilities, which these tend to be more defensive. Then the NASDAQ went below 16.3, 16.2, then got back up to 16.4. And real estate, another basically defensive area, had a BPI cross above 50. The S&P was able to get back above 5,300. So, I mean, it's just really not a lot of conviction here, but these signals get triggered as we go across certain lines. We did have the NYSE have a BPI cross above 30, and that's been one of the better indexes to hold up, and it's still in an uptrend. And then the BPI crossed above 30 with the NASDAQ, and materials, which tends to be more economically driven, had a BPI cross above 30. So some improvement, but the improvements are more defensive rather than being growth oriented. So here's the Dow. We're now seeing a death cross with the Dow, and we are negative with the diamonds when looking at the Elder's Impulse system. We've already been negative with the NASDAQ, and we are negative with the Elder's Impulse system for the NASDAQ. The NASDAQ 100, a recent addition to the list, is now in a downtrend. Elder's Impulse system for the Qs are negative. The momentum, though, is positive. That's seeing an improvement as we were trying to bounce back up here, measured by the PPO. Small caps are in a downtrend. The Russell 2000 small caps are in a downtrend. We're still neutral though with the Elders Impulse system for the small caps. Mid caps are in a downtrend and still neutral with the Elders Impulse system. Financial sector still hanging out just a little bit below its 200-day moving average. Keeping an eye on this. This uptrend is a little bit stronger, but the longer we stay down here, the more this blue line is going to come down. The Wilshire, a broad market measure, is now seeing a death cross here in a downtrend, hanging on to an uptrend, but a weakening uptrend with the FANG index. These are the really big stocks. Apple was up 1.39%, but it's in a downtrend. Amazon getting close to getting into a downtrend here. It was down about 1%. Microsoft has been in a downtrend. It was down over 1%. Google is also in a downtrend, down 1.42%. Nvidia in a downtrend, down 2.87%. Tesla, recent addition here with the death cross, and it was virtually unchanged. Meta holding up a little bit better with the trend, but it's still hanging out for a long time below its 200-day moving average. Netflix is actually looking better. It's above its 50-day moving average, and the trend is a little more established. And still fairly strong correlation between US and world stocks in the short term and showing the longer term correlation strengthening. And oil coming up here, we were in the low 60s. Now we're getting back into the mid 60s. And the dollar continues to be below 100. And now we're seeing a death cross here with the daily chart of the dollar index. And we did come up here with the 10-year yield. This is when we really started to go up, and that was freaking the markets out. We have been coming down, but we saw a little bit of a bounce on Thursday and a little bit of a decline here with the 10-year based on price. And not really seeing much change here. The growth to value ratios, the Qs to S&P were dropping under the moving average. Discretionary to S&P still under the moving average, even though it ticked up. And now we're going back under the moving average when we compare large cap growth to value. So the large caps under the moving average, coming down to the moving average with the mid caps, and also seeing some weakness with the small cap ratio. This is also showing the markets getting more defensive. Staples are outperforming the S&P. It's more positive when this ratio goes down, and lately it's been going up. So what's our outlook for Monday? We're negative across the board in the short, intermediate, and long term. We will get the LEI, the leading economic index, not considered a major report, but we can still get some insight from it based on what's happening with the economy. And then anything that happens, and let's hope we get through this holiday weekend with nothing really crazy. There's all kinds of potential geopolitical things that could happen. Of course, now there's political things and trade wars and tariffs and all kinds of things going on there that's really adding to this unsettled feeling. And then here is the economic calendar for the upcoming week. We won't have any economic reports on Tuesday. Not a real big week here. We're going to get the global manufacturing and services PMIs. Jobless claims will be the big one on Thursday, and then we'll get consumer sentiment on Friday. This is showing that the next major reports here will be on Wednesday. Seasonality for April 21st, we're positive with the Dow and we're neutral to positive with the S&P and NASDAQ. And now we'll be entering in the week after options expiration, where we still tend to lean more to the upside and see a little bit of positive seasonality here, whether we look at all years together, a little bit of a tick up here during a post-election year. So we're looking more negative now with our three smart money indicators. It depends on how you interpret accumulation distribution. If it's coming down and that's the context that you use, then that's negative. If you use it, whether it's above or below its moving average, then you're still positive with that indicator. The Chaikin money flow and the Chaikin oscillator are negative, and we're turning more negative now with our long-term growth to value ratio. We're trying to improve, but our oscillators are still pretty much negative. The moving average studies are negative. The ease of movement and the vortex is negative, and it's gold because it's a primary indicator. And then our long-term special K is still negative and probably will be for quite some time. Then on the positive side, we're still holding on to an uptrend with discretionary to staples, but we've been hanging out below that 200-day moving average, and we're pretty much negative in the short term. We did slip back over to positive with the S&P and NYSE McClellan oscillators and summation indexes. So that's a little bit of an internal improvement there. Parabolic SAR is still positive. The bullish percent indexes have been doing fairly well. Swollen trading oscillators switch back to positive. The money flow, a new addition to the list, is not positive, and the ultimate oscillator is positive. And the financial sector still hanging on to an uptrend, but even though it's been under some pressure lately, and the momentum for the NASDAQ 100 is positive. And then we have this mass index, and still trying to figure out if there's really anything to that right now. So, our conclusion, we are negative in the short, intermediate, and long term. And really no changes here. We do have some oversold readings in the short and intermediate term, but we're not necessarily showing capitulation type of oversold readings. But now in the long term, we are negative. We have a recent death cross and we're below the 200-day simple moving average. Thank you. I hope everybody has a really nice weekend, a great Easter, and I will talk to you in the next video.